everyone, and welcome back to the Ask Avidian podcast. I'm Jake Borbidge, Chief Investment Officer here at Avidian Wealth Solutions, and today we've got a guest appearance from Andrei Costas, one of our portfolio managers and also the individual responsible for most of the investor communication and client communication that comes out of the investment team. So, Andrei, thanks for joining me today.
Hey, thanks a lot, Jake. Great to be here.
We've got a little bit of a kind of special treat. So every 6 months or so, our investment team gets our heads together. We look at what we're seeing in the marketplace. We look at what's happened recently. We look at what we think might happen over the next 6 to 12 months and maybe even longer. And we put out something, sometimes we call it a private client report. Sometimes, usually halfway through the year, we call it a mid-year outlook. So typically what we're trying to do is we're trying to get our best thinking together, the most important observations that we think are going to move markets, and just communicate them out to our clients so they have an idea of what we're thinking, what we might be doing with our portfolios going forward, and also just really to be additionally and over the top transparent with our clients. We want to make sure that everybody is in the loop with what we're doing and how we're managing portfolios. So today what we're going to do is we're actually going to give a little bit of an audio kind of preview into what's going to be coming in that Outlook report. Should be released in the next couple weeks. So hopefully this is helpful, interesting. Andrei, I think it's probably worth, so typically what we try to do, in addition to being transparent, we want to be accountable to our clients. And so when we write something 6 months, a year ago, we typically go back to what we said and were we right, were we wrong? Like, what's our scorecard, right? So maybe let's start there. Andrei, if you look back at what we said in January, we talked to clients, what were the things that we said, are likely to happen given the layout, the economic layout, the macroeconomic driven policies that were changing, and the new president?
Yeah, no, it's a great question, and one that we definitely will cover in depth. Coming into this year, we definitely were expecting earnings growth to really continue, getting a boost from kind of Trump 2.0, if you will. I think there was a lot of anticipation over, some of the pro-business policies that this administration would, really unleash and be able to drive, some of that economic performance. Mm-hmm. We also expected inflation to bottom. That has maybe not worked out quite the way that we initially thought. A lot of that driven obviously by some of the tariffs that have, kind of been in the headlines here over the last several months. We also expected increased M&A, so mergers and acquisitions activity. I think while I would say we were pretty much right in terms of that developing, I think the timing was probably a little bit off. I think if you look over the last several weeks, we have gotten indications that M&A is starting to finally pick up across different sectors of the economy. Increasing interest rate volatility, I think that has been very much, kind of front of mind and really front and center. We've seen, certainly treasury yields kind of jump around quite a bit. Yeah. And then, all of this is really kind of driven what we thought would be a broadening out of kind of market performance, really from, what was kind of the Mag 7 to a broader set of, sectors and industries really kind of picking up and kind of catching up to some of those high flyers.
Well, let's start with the growth side of things, because I think we have to dial the clock back a little bit. Think about what was going on in January. The president had just been sworn in. Depending on when we were writing the thing, maybe he was about to be sworn in as our new president. A lot of optimism. We looked at kind of the odds of a recession. Predicted across the market in January, very, very low odds, right? Everybody is very positive on the economic prospects of the U.S. and then actually on globally as well. And that did change fairly quickly, right? So in Q1, we actually had a significant drag on GDP growth, mainly because of of activity by companies to get ahead of tariffs, right? Importing significantly higher than the higher amounts of inventory than they would typically do in Q1 to get ahead of tariffs, right? So that actually negatively impacted GDP. I don't necessarily know that it had a huge dampening effect on earnings, but I would say, if we were expecting a boost from some of the pro-growth policies of the Trump 2.0 economy, which I haven't heard that term used, Trump 2.0, haven't heard that term used a lot in the last couple months, but some of the boosts that we expected to see, tax cuts, decline in regulation, those sorts of things. From a timeline perspective, I wouldn't say that those are not going to happen, but they haven't happened in the first half of the year. We got OBA towards, I'll call that second half, right? So we'll write and talk about that probably in January of next year. But that didn't, we didn't get that tailwind. And actually, I don't think the market had a whole lot of speculation up until June that would actually be something that was a tailwind. From a deregulation perspective, part of OBA is removing regulations. But again, that's all kind of more, very back half of the first half of the year and probably second half effects. And so earnings growth really didn't see much of a tailwind, and a lot of discontentment and just concern around the impact of tariffs, right? Have we seen a big influence of tariffs on earnings? We're starting to get some Q2 earnings in here, over the next couple of weeks. Has it been a big dampener so far?
I wouldn't say that it has been a huge dampener. I mean, I think very much in line with kind of what you were talking about with, inventory levels kind of, being adjusted ahead of time.
Yeah, so inventory builds is going to, be a modest, like it's additional cost, right, without revenue. So it's a modest dampener, but nothing falling off the cliff, right?
Exactly. And I think that has largely continued. If you kind of look at the earnings picture.
And I think if you were to look at, take it a step further, right? So you would typically think, okay, if you have a big tariff concern and you front load your inventory, maybe you don't see the impact of tariffs on your prices because you have a lot of inventory that came in before those tariffs took place. So if we're trying to figure out what's going on with inflation and how are tariffs going to impact inflation, I think a lot of market forecasters would have said, well, Q1 it's going to be really hard to figure out, right? Because tariffs didn't hit till Q2. But by the time the end of Q2 rolls around, we should have a really good feel for, are tariffs impacting inflation in terms of higher prices? Are they impacting earnings in terms of maybe stable or modestly higher prices, and corporations consuming the impact of those higher prices of their costs, right? So basically tighter margins and lower earnings. However, I think what we're seeing is actually a little bit of a pushback to that effect as well, right?
Yeah, I think that's absolutely right. And I think a big part of that is, anytime you have something like a tariff introduced, these multinational companies, large companies can certainly pivot and, kind of change their supply chains quite a bit in order to offset some of those things. And so my expectation is, as we kind of go forward and we start to get more indications of earnings and kind of the tariff impact, my guess is we're probably going to start to see, a lot of those shifts, actually paying dividends.
Yeah, and so that's definitely helped, I think, price stability. But it's made it really hard for us to figure out, did tariffs actually drive, are tariffs driving inflation, right?
Exactly.
So every economist would have said in January, yes, tariffs, yes, inflation. If you get tariffs, you're going to get inflation. It's just a lockstep function. Very little credence given to the ability to be flexible on inventories, to have margin, flexibility if you want to be competitive in a business landscape. And so we're trying to get a good read on that. With regards to inflation bottoming, so I think inflation actually has been surprisingly soft so far this year.
Yeah,
and it's been confounding, I think, to the Fed when we look at interest rates, because the Fed is trying to be data driven. Employment is very strong. Inflation, up until this past month had continued to soften, modestly, or at least be stable and, surprisingly less positive given obviously the action around tariffs. So the Fed's job in managing the short end of the interest rate curve, I think has been quite challenging, right? A lot of pressure externally. And one of the things that we've seen is like the short end of the curve really hasn't moved.
Right.
Obviously there's been no cuts this year, right? So that Fed funds rate target has been 100% static. The expectations around how many cuts we get have moved a decent amount, plus or minus a few cuts, which has really been the long end of the curve.
Yeah.
The 10-year and beyond, the 20-year, the 30-year, that have been jumping all over the place, right?
Yeah.
What did we see? So thinking about the 10-year, thinking about that, kind of more longer term rate, what did we see when we started to get news around tariffs and really start to see some of those initial headline tariff numbers hit?
Yeah, no, it's an important point, because really once we started to get a little bit more clarity on, tariffs, who would be impacted and to what degree, we really did start to see the long end of the Treasury curve move up, north of 5%. Obviously, that kind of indicated just kind of rising inflation expectations, and really what ultimately was an area of concern for a lot of investors.
Yeah, and the rise up wasn't just a smooth tick up to 5%. I mean, it was a bumpy ride, and there were some days where it looked like it was going to drop precipitously and started out dropping and came back up. Mm-hmm. And I think it's a combination of things, right? As we're going through this tariff situation, there are external concerns around the viability of the U.S. ability to pay its debts. Mm-hmm. Part of that is because if you extrapolate a negative economic impact to tariffs, right, globally, you obviously have less tax revenue due to lower economic activity. Part of it is, the demand for dollars in the future. Mm-hmm. So if your expectation is significantly lower trade globally, right, maybe the U.S. isn't a loser on a relative basis, but if there's just less trade going on globally, and the dollar is a reserve currency where a lot of that trade takes place, less trade means less demand for dollars. So there was definitely a dumping of some of those intermediate and longer term treasuries onto the market, because the holders of those foreign countries assume that they didn't need as much, right? If you're not going to be trading as much, you don't need as much dollars in reserve. So we definitely, if we're scoring ourselves, I think predicting interest rate volatility we were definitely on point regarding that. The M&A side of things, this is a prediction that we had. It's also a prediction that I think a lot of private market investors had, mm-hmm. maybe a little bit overly optimistic in terms of the thawing of the M&A market and also the thawing of the IPO market. We've seen a few notable IPOs this year. Mm-hmm. A couple of them have done actually pretty well. But by and large, I think the count and the amount of capital being raised in IPOs, there's still probably more of a backlog than there are deals that have gotten done. Would mm-hmm. you agree with that?
Yeah, I would absolutely agree with that. There's definitely a backlog there. And, maybe as we get into the second half of this year, maybe some of those kind of start to actually materialize. Yep. And you do get, more IPO activity. As well as more M&A. Yeah,
and where do you think the heads are at of the, like the CEOs, the directors of the private companies that we invest in? Like when they, if they were looking at either buying, a bolt-on acquisition or mm-hmm. expanding their own operations, or if they were looking at selling their firm in March with plans to do it through Q2, what do you think happened to their timeline?
Yeah, their timeline probably was probably extended just a bit, as they kind of waited to see, some of these data points kind of come in. Obviously, if you look at public markets, we do have valuations that are a little bit stretched, which, in some ways may make some of those kind of IPOs more attractive to pursue. Yeah, definitely. But on the M&A side, obviously those valuations obviously are less attractive. And so that can be a little bit of a headwind, I think, for more M&A activity. So, it's really kind of a balance, I think, that has to be struck there.
Yeah, and you do have, if you were trying to sell or buy a business, right, volatility in terms of the price of that business is a challenge, and that's something that you can typically, if you have to, kind of pay a couple points up in terms of multiples, you can get around that if you have confidence in the economic environment, because you can always grow through a higher or a lower multiple, right? You can look at that as, okay, that's Correct. A temporarily higher price I got to pay, but if you are highly uncertain about what the economic environment is or your ability to trade and transact in the products and the services that you're marketing, that's a much bigger concern, right? And that will definitely cause transactions to seize up. So I think what you had in April and May, you had this heightened level of not just market volatility, but also policy uncertainty, economic uncertainty, which I think a lot of that is subsiding over the last couple of months. Market volatility obviously has subsided, but also just the level of uncertainty around what's the economic environment going to look like. It's not awesome having higher rates across the board. I think most, CFOs and CEOs would prefer lower rates because it brings their borrowing costs down. So it's not the most conducive to, taking on leverage, but at least having some clarity and some transparency is definitely something that can help drive deals in the market. And while multiples are high, it is attractive to IPO into a public market, right? You definitely get that uplift in your stock price. So if we look back at, okay, well, what, we did expect a broadening of market participants, right? The benefits to, call it Trump 2.0, are, I think, designed to benefit a broader set of companies as opposed to the Mag 7. If we say those effects have been kind of put off a little bit, we did get some pockets of call it performance where you could see that broadening start to happen, and then it would trend backwards, right? Back to the momentum stocks, back to the Mag 7, which most of them have done fairly well this year, although they had some pretty low bottoms, right? But without digging into individual stocks, let's talk more globally. What's been going on performance-wise in equities out, U.S. outside the U.S. so far this year?
Yeah, it's a great point because, if you look back, a year ago, a lot of what people were talking about was, are international stocks no longer, kind of viable within a diversified portfolio?
Yeah, it's been a long time since they'd worked, right?
A very, very long time. Fast forward to this year, though, we've actually finally seen that tide shift a bit. So we've actually seen international markets definitely pick up the slack. They have, certainly outperformed domestic markets, and some pockets of international, countries and regions definitely are stronger than others. But generally speaking, I think a lot of this is kind of driven by, not only some of the uncertainty here domestically, but also some of the currency impacts, et cetera, that, kind of tariffs have introduced.
Yeah, a lot of I told you so's in the diversification camp, right?
Yeah.
So, I mean, it's been, U.S. exceptionalism, U.S. growth has been just so exceptional, right, over the last couple of years that anybody doing anything outside the U.S. has kind of felt a little bit sheepish, right? Does it make sense to have a global portfolio? Really hard to make that case when, the rest of the world has underperformed pretty consistently, even those sectors that are higher risk, right? Typically, you think higher risk emerging markets, it typically justifies higher return, and along with that volatility. But, in retrospect, up until, call it January of this year, that just hasn't been true. But, diversification does pay dividends over time. I told you so as well. Our clients do tend to have globally diversified portfolios. They may own more U.S. equities than they own international equities. And I think that makes sense. That's a prudent thing for a U.S. investor to do. But typically our clients are not going to have zero non-U.S. allocation. There's always going to be a diversification benefit. And while the U.S. has done a good job of rebounding, it's been tremendously resilient so far this year in the face of a lot of, headline volatility, policy volatility, economic volatility. Still the non-U.S. securities have outperformed quite a bit. If we look into our own portfolios, we don't own every country. We don't own Canada right now. We're a little bit overweight Japan. Japan hasn't been phenomenal this year. It's been better in years past. And we don't own China in most of our portfolios. China's been really strong.
Yeah, they've been very stimulative in China for a while now.
Yep, and that's been a little bit. I'll call that a little bit of a surprise. I think stimulus versus the headwinds of being a target of these tariff policies, the stimulus has really won out, right? And if I knew how to say "don't fight the Fed" in Chinese, I would probably say that right now because I think it's kind of the same thing, right? You've got a lot of stimulus, a lot of increase in supply of money, reduction in the cost of money and the cost, interest rate costs, and stability in the currency. I mean, all those things have really kind of amounted to a good rebound in the Chinese equity market. We do own Mexico. That's kind of one of our emerging market countries that we invest into, as well as India, both as tactical positions. Mexico's done really well this year.
Yeah, Mexico for the first half of the year, up nearly 20%. Yeah. So again, that's kind of a bright spot when you look at the country specific performance.
Yeah, and Mexico had some troubles in 2024, mostly politically driven. I think a lot of those troubles have, I wouldn't call them forgotten by the market, but the market's willing to look past that. And Mexico also was ahead of the curve in getting tariff agreements put into place. We'll see rhetoric every now and then about we need to go back and rework the MCTA, right? It's the MCTA. But by and large, like, they had an agreement in place. They didn't really have to suffer through the volatility of tariff headlines. So, a little bit of a bright spot in the portfolio there.
Yeah, definitely. And I think the reason why we even added Mexico to the portfolio was really kind of this, reshoring and onshoring theme, which, obviously with tariffs, that has kind of pushed a lot of that into the forefront. And so that has been a beneficiary of that movement.
Yeah. So, okay, let's skip on to the fixed income market. So we talked a little bit about interest rates already. Obviously have been volatile this year. We've got a steeper yield curve than we've typically had over the last handful of years. But the short end is still at, just north of 4%. The long end is close to 5%, depending on the day that you check. So you have a little bit of positive slope to that yield curve. In terms of the opportunity, how does that, like, we'll call that the spread that you collect for lending to the government for longer periods of time. Let's just say it's around 100, maybe a little bit more than 100 basis points. How does that compare to what we would typically expect in a normal environment?
Yeah, I mean, it's a great question. I mean, I think in a normal environment, you definitely would see a little bit more of a spread there.
So 100 basis points is not a really great number. It's a little bit more than we're used to, right? But
exactly.
Okay.
Exactly. And I think the other thing to kind of make a note of is also the shape of the curve. We do have a little bit of a dip in the belly of the curve. And so, really that kind of speaks to, again, a little bit of that divergence that you're seeing between the short and the long end, but also, some of the, kind of intermediate term fixed income market dynamics, that are kind of playing out.
Yes, I mean, investors are willing to lend to the U.S. government, much more willing to lend over a 2 or 3 year time period. So that part has been bought up, right?
Exactly.
Or the rates have been bought down. But when you talk about 10 or 20 years, less confidence there, right?
Yeah.
And so, I mean, we could speculate on whether the U.S. dollar is going to, remain as the reserve currency. I see no replacement today. People will speculate around blockchain and stable coins, and maybe that will replace, the U.S. dollar as reserve currency. We saw some news just over the last week that, that's at least for now. Stable coins will not be able to replace the dollar as a reserve currency because they have to be anchored to another reserve currency. The dollar is one of those, right, in the U.S. So anyways, a lot of concerns going, when you read into the yield curve, just a lot of competing factors there. Demand for treasuries versus supply, speculation around the risk of treasuries, the credit worthiness of the U.S. Economy or U.S. government. So let's pivot to spreads, right? So typically in our portfolios, we typically are underweight treasuries, not structurally, but strategically, we tend to be underweight treasuries because we like to collect a little bit of a return premium by lending to corporations, which are maybe not as credit worthy as the U.S. government because they can't print their own money,
right.
But they also have a exceedingly long track record of paying their debts, right? So very high quality in credit. So we tend to be a little bit overweight investment grade credit in our portfolios, and we monitor and we watch the less credit-worthy pockets of the market. We've typically, over the last couple of years, preferred to lend into the less credit-worthy pockets of the market through private lending as opposed to syndicated or liquid high yield. But we do keep an eye because it's nice to have that liquidity if you're taking on some significant credit risk. And so where is that market today?
Yeah, no, it's a great point, and really what we've seen is, especially since you just kind of mentioned, kind of the private markets, what we've seen is, yields in the private markets have continued to look very healthy. In many kind of private lending, kind of opportunities that we track and follow, you're kind of in that 8 to 10% range. But then if you look at public kind of high yield, there what we've started to see is a narrowing of, kind of the spreads between public and private. And so, while private markets still look to be an attractive place to get yield, I think as we move forward, we have to continue to watch.
We keep an eye on it, right?
Yeah.
We really have to. There was a brief period of time in April and probably in May as well, where the liquid side of the market, the high yield market, the spreads had widened out a good bit, right? I'll say it was more widening than we had seen in the last couple years.
Yeah.
And so that really kind of perked up our ears. Hey, do we need to revisit private credit? What we saw was that, yes, we got wider spreads than we had seen maybe in the last 2 or 3 years. But if we compare those spreads to environments where we had significant, credit concerns which justify spread widening, they were still pretty tight.
Yeah.
If you go back to 2015, where we had some significant credit situations, spreads were much wider back then. 2008, really no comparison. And even at their widest point, in April, we were still collecting a premium in the private space, right? So it's something that we'll definitely watch. Spreads have come back in. And so, we're still collecting that premium in the private space, but it's definitely something that we're going to keep an eye on as markets move forward. Okay, so a good bit of commentary there. And that kind of brings us up to, kind of early July, right? What's the market telling us today? What's it telling us about rates right now?
Yeah,
where are rates going?
Yeah, I think if you kind of take a look at, rates, I think what we kind of see going forward is probably slightly lower short rates, kind of based on where we are. We have started to see, those.
So in just slightly lower short rates implies some level of Fed cutting, right?
Exactly. I was just going to say, if you kind of look at, kind of the Fed dot plot, what you're kind of seeing there is, maybe somewhere, between 1 and 2 cuts between now and the end of the year. And so, again, I think you're kind of priced in for that type of move.
Yep.
Whether that materializes, I think remains to be seen, especially in the face of, potential declining growth, depending on how earnings look.
Okay. And I'm just going to clarify for our audience, we're not bringing out our crystal ball. We don't talk about on radio, right?
Yeah, that's right.
But this is just saying, okay, if the market has a crystal ball and it is communicating those views to us, this is kind of what the market is giving us today. So one of the things the market is saying is, you'll probably get some rate cuts. The Fed seems like they're open to cutting rates, but they're also saying they need to be data dependent. So right now we haven't seen anything data-wise that would say, yes, you can cut rates because inflation is starting to tick back up a little bit. Potentially, there's some upward pressure as tariffs work their way further through the system. And then there's some potentially positive demand drivers, which are good to have. Tax cuts are good to have. Deregulation, those are all good things to have. They increase economic activity, but they don't necessarily give the Fed any additional ammunition to cut rates, right?
That's right.
It almost kind of makes the data skew to the positive economic activity, positive growth. Okay, the Fed says there's no need for me to loosen because the economy is just fine with the rates picture that I've got going on. So anything else that the market's telling, like what is the market telling us on growth now? What's the U.S. economy supposed to do through 2025?
Yeah, I think what you kind of see there is a leveling out of kind of growth expectations. Obviously,
no recession in the cards right now.
Well, right now, no recession in the cards. Although I will say, there may be some pockets of deterioration that we're kind of watching.
Yep.
But again, I think broadly speaking, if you look at especially kind of the top end of the consumer, very strong, as well as some potential buffers there if we do hit any speed bumps. So.
Yeah. Okay. So how is the market today, right? How's it digesting all of this news? I feel like, as we started our journey through I remember Liberation Day, the tweets, right? The market response to the tweets, and then the intraday, switching back and forth of the color of tweets would result in market switches back and forth, right? So that was kind of the initial, first couple days and weeks of this environment. I kind of feel like the market's, gotten a little bit used to hearing those narratives. Maybe the market had forgotten what a Trump presidency was like. It's a very tweet-heavy presidency, and you don't need to respond to everything.
Yeah.
So some of that stuff is kind of muted from a volatility perspective. Where's the market's risk appetite today? Is it a risk-seeking market, risk-averse, somewhere in the middle?
Yeah, I would say it's a little bit more risk-seeking at this point.
Okay.
We do track a signal that does measure kind of risk seeking across the market in both large cap as well as kind of small cap sectors of the economy. And really there, we are seeing a little bit more risk seeking. And a lot of that is seen in the performance of, again, those momentum stocks that have continued to
risk seeking,
kind of move higher.
Yeah, just generally risk seeking means that the market or investors are less concerned about paying a high price or a high multiple of earnings or cash flows or revenues. You get more comfortable with that, right?
Exactly.
And you think more about just kind of the near-term upside as opposed to how do I justify these multiples over a long period of time.
Right.
So good point there. Last thing I think we want to chat about is, what things do we think what are we watching? What are the flags that if we see something, show up that we might actually get a little bit concerned? And where are those at today? So, we've talked a good bit about inflation and growth, but, if you look at the U.S. economy, a lot of the economic activity is driven by, personal consumption, right? We are a consumer-driven economy today. So one of the things that really matters is the health of the U.S. consumer. And I mean, I'll be a little bit, ethnocentric here. I think the health of the U.S. consumer matters for international markets quite a bit as well, because we still are a net importer of most products and services. So where is the consumer today?
Yeah, I think what we have is almost a bifurcated market a little bit. You have the top end consumer, which continues to be pretty resilient, and then you have kind of the low end consumer, which is beginning to show some signs of stress, especially if you look at delinquencies in credit cards. We obviously recently got kind of a reinstitution of kind of student loan repayment mandates. All of that is likely to really trickle down and hit that low end consumer. Whereas if you look at, for example, HELOCs, home equity lines of credit, things like that, those have really not ticked up, which really signal two things. One of them is that the top end consumer continues to be fairly resilient and strong from a balance sheet perspective. Yeah. And then secondly, I would say that, the kind of the activity in the HELOCs are, I guess I'll say the lack thereof, really kind of shows that there's a potential buffer actually in place.
Yeah, potentially a lot of dry powder.
Yeah,
right?
Exactly. I mean, that's definitely a place where, especially on the top end, you might be able to draw some liquidity if you do hit a more difficult period.
So really good points, and I think that kind of helps us understand a couple things. One layer down, right? Which is, if you were to say the lower income end of consumers, given some stimulus, right? They're going to receive some stimulus through tax cuts, through additional child tax credits, and some other things that went into OBA. The use of those funds is likely going to be to get back above water, right? Broadly speaking. So maybe that means that once those funds are received in some form of cash stimulus, maybe you see those credit card delinquencies come down a little bit. Maybe you see the auto loans get caught back up to current, and those delinquencies come down a little bit. But unlikely there's going to be a COVID-driven, spending or cash surplus that would drive additional consumption.
That's right.
Yeah. And so I think that's important to understand. Like with regards to inflation, there's no demand impulse there to drive spending from the lower end of the consumer side of things. However, on the upper end, you have the thing that we typically have a hard time contextualizing, the wealth effect of rising equity markets. Yeah. And again, that's something that, that effect continues to compound and create bigger disparities in wealth over time versus smaller disparities. So that wealth effect has continued to compound this year. There were pockets of time where, we thought, okay, well, the market's down or US is down and international is up, and maybe that wealth effect is, flat to down so far this year. But I mean, at this point in time, at end of June, I think international markets were up 20%. US had bounced back and positive 6-7%, depending on the index that you look at, maybe even a little bit more. So still a positive wealth effect, right? So you kind of almost have like, you have two stores of value. One is your wealth effect with your equity portfolio, or in the case of our clients, probably a mixture of public equity and private equity. Income that you're receiving from credit has still been stable. Our private credit funds have been able to continue to maintain high levels of income, right? So that's all supportive. And then you have this untapped thing that you don't want to use your equity line of credit. One, because you're putting your house on the line at risk. Two, because rates are high, right? And that leverage is not cheap. But now it's, it could potentially be tax deductible depending on what you're using that for. There's also tax deductible auto loans that came out with OBA, right? So additional stimulus there through, if you buy a new car and you're paying interest on it, you're going to get a little bit of a tax rebate there. So a lot of things that, potentially could help out the upper end consumer and just provide additional resilience. So it gives us a little bit of confidence that, even with the volatility and a lot of things going on in the market, that the consumption side of the U.S. economy is probably going to still remain surprisingly resilient in the face of all these challenges. So a couple things to think about for our clients, right? And this is going to be something that, probably a little hard to execute on your own, but definitely a good reason to give your Avidian advisor a call. Or if you're listening, you're not an Avidian client, it's super easy to become one. You just come check us out on avidianwealth.com is where you'll get plugged in. But what are some of the themes that we've really been trying to educate our clients about over the last couple quarters that we think are still resilient going forward?
Yeah, it's a great question, and really where we have kind of landed here is definitely looking definitely at private markets. There are definitely some compelling opportunities in private markets. So some of the things that we are watching: real estate recovery. We have started to see some pockets of weakness, but eventually we do think that kind of works itself out. So kind of looking for opportunities to kind of
less inventory coming on the market this year,
absolutely,
right?
Absolutely.
Yep.
We also have the AI value chain. So AI has been pretty much the topic of the day, I think, for most sectors and industries. But there are various ways to play that, whether that's data centers or even kind of a more picks and shovels type of approach to AI.
Even power generation has a big AI tail right now, right?
Yeah, exactly.
So electricity generation.
Correct. I mean, that would be another place. Defense renaissance, that's kind of one of our big themes.
So what is defense? What does that even mean? Defense renaissance.
So really, it's
knights in shining armor. Is that the Renaissance ages, right? Is that
nothing like that? Really more than anything, it is just kind of a move toward kind of shoring up kind of defense industry spending, technology also playing a big role there, and looking for opportunities to really capture some of those tailwinds.
And I think that industry is getting a little bit of tailwind too, because we have now foreign countries, right, the other NATO members committing to higher percentage of GDP spend on their own defense budgets, right?
Correct.
So that's something that we didn't have over the last couple of years. That's kind of a new entrant, a new little pocket of stimulus into that particular sector.
Exactly.
Yeah.
And then, you actually alluded to, kind of energy. So energy infrastructure, generally speaking, as we, continue to see more of a domestic centric kind of policy environment, we think that may be an area that, ultimately benefits.
Okay. Andrei, this has been a lot of fun, really informative to me. I really appreciate your time. Again, if y'all want to take this conversation deeper or really just kind of see how your portfolio stacks up against some of the things that we're talking about, just come check us out at avidianwealth.com.